I think we're live. So let's go live, ladies and gentlemen. So again, ladies and gentlemen, thank you for being on Pebble by CoCreate. This is your host, Vishal Krishna. I've got a wonderful session for you today. I have with me the lovely Shefali Nagendra, who's my co-host. She's a student leader, community leader. We have with us Shashank Randev, the founder of 100x.VC. I've been tracking this company for a long time now. And let me tell you one thing, you'll be surprised with the rate at which some of their idea state startups going up to the next level, right? That's what I want to bring out today on how their idea state startups scale up. I also want to know from Shashank, what does he do in his own personal time? That's towards the end of the show. Shashank in the past has worked with the likes of VC Circle and Z Nation, but it's in 100x that they've shown us what it means to scale up idea state startups. We're all very honored to have him here. Shank, thank you for being on Pebble by CoCreate. By the way, guys, Pebble by CoCreate is to inspire students to start up, okay? And we've already helped 26 such startups. You should talk to us. I'll give you our email in a bit. Shashank, how are you?
I'm doing wonderful. And thank you so much, Vishal, for inviting me. It's always an absolute pleasure talking to you, hearing you, and seeing you interact with so many different kind of people. I was just talking to you earlier and mentioned that, your sessions not only inspire the student community, but also the investor community, right? Because of the kind of interactions, we get to learn a lot in terms of trends. But thank you so much for inviting me here.
No, you've always been kind to me, and our in time we've crossed our paths so many times. I'm impressed with the fact that you bought in something called iSafe Notes. Let's start there.
Sure.
Perhaps let's also start off in the history. How did you and Sanjay get together? Why did you launch something like this? Sure. Right? I'll tell you when I heard of 100x. I was on a bus in San Jose, and I ran into the other one of your co-founders, CTO Vatsal, and he kept talking about this fund that's going to make impact at the idea stage. We're going to change India. We're going to fund hundreds of startups. Everyone was thinking, how is that even possible? 1 year, 100 startups, that's possible. And you guys have made it happen. Talk about the history. Let's talk about iSafe Notes after that. Shefali, you want to add something?
Yeah, I just wanted to add that, you are an engineer, Shashank. So how did you get into the world of, investing and all of that? Because I myself, I'm in the route of becoming an engineer. So I'm very curious.
Sure. No, great. Thank you again, Shefali and Vishal, for having me here. I'm very excited to be talking. I'll quickly cover the background and how I met Sanjay. I'll begin with your question first, Shefali. I'm an engineer. How did I land up at this point? So very, very quickly, did my engineering in electronics and telecommunication, passed out in 2003. My first job was at a Gujarati polyfilm manufacturing company, selling polyfilms and just keeping a track of invoices because I was preparing for my GMAT. And then, that didn't happen. I didn't leave the country. I ended up in Pune. Was working with Zensar Technologies, then moved on to New Delhi. I worked with NIIT Limited in their Learning Management Solutions division before deciding that, MBA is the path to glory. And I ended up joining an MBA program in 2008 in New Delhi. I did my MBA from IMI New Delhi. Post which I realized I didn't want to work for corporates, and that was my first phase. And I was deciding to go back to NIIT because I hadn't burnt my bridges. I had good relationships. My boss was nice, and that's when I was unemployed because I was part of the placement committee, and the 2008 fiasco happened. Everybody else got placed in my batch. I didn't. So I decided to go to Manali, and I came back and we were unemployed, 5 of us, the placement cell guys, and we happened to be part of an annual get together. My alumni get together. And that's when I bumped into another alumni for the first time who had recently come back from London after pursuing another master's in London School of Economics. And he was working on a research platform. He said, the co-founder is looking for a co-founding team member and you'll have to move back to Bombay. And that's where my heart was, in Bombay. I always loved the city. So I then went on to become the founding member for VC Circle, a media tech platform company, and headed their data platform called VCC Edge. And moved to Bombay to set up the entire thing. Very, very non-linear track, had no agenda in life. It's just that I didn't want to pursue MSc And hence I just kept on hopping, a very confused state of mind, to be very honest. Things just happened. But VC Circle was when things started getting very excited for me, because I started understanding what private equity and venture capital industry meant. I started meeting these guys and started selling them a time being almost thrown out of their offices to build a better product, and a lot of learnings from those insightful conversations since 2009. And that's how I also got to know Sanjay as a professional acquaintance, friend, mentor. He was doing a lot of angel investments, and VC Circle got acquired by News Corporation. So I moved out. I joined Z Nation Lab, and then I bumped into Sanjay again after Z Nation Lab, and that's how the whole 100x thing came into existence. He had this idea. I said, I'd love to join. Let's work together on this. And he said, I'm looking for a great team. So, we are going to be 5 partners over here. And I happen to know Ninad, and that's just how the team got formed. So that's a quick overview of engineering to 100x.
Okay, this is phenomenal, right? This is where I want to start. You guys revolutionized the whole thing with something called the iSafe Notes.
Right.
Let's get that out of the way, because a lot of the people ask us what iSafe Notes is. It is on their website, ladies and gentlemen, but still, we're going to get it out of Shashank. And I think you should read that through in the website, because it makes a lot of sense. Shashank, in a nutshell, what is that and why is it founder friendly?
Sure. So iSafe is a document which is essentially helping founders raise capital sooner than later, without going through the legal hassles. It's called India's Simple Agreement for Future Equity. It enables founders to raise capital for a future equity and not diluting equity upfront. And that's the simple concept. Now, through our vantage points, all 5 partners, Sanjay, Ninad, Yagnesh, myself, and Vatsal, throughout the whole Indian ecosystem journey, we realized that the SHA, or shareholders agreement, or price rounds, were where bulk of the transactions were happening. But also because 2009 and 10 was a different ecosystem. You had private equity and venture capital doing a lot of investments. There weren't many seed funds, and there weren't many startups. Now, in 2019, we had suddenly a surge of startups coming into the ecosystem, and good ones, who not necessarily required a valuation to be pegged, because they were just discovering the process of product development, finding a product market fit. And we then realized that India has now reached a point where possibly Silicon Valley was in the early 2000s. And that's where Y Combinator kind of stepped in and built this process of safe instruments. And we felt something along the same lines in India, which was a convertible, but not a convertible debt, but a convertible preference share, a condensed version, which would enable founders and young people like Shefali's generation to kind of come in, start, not be fearsome, not be apprehensive of starting an idea, build something, and ability to raise money through this instrument within 10 to 15 days. That's how the whole iSafe came into existence. And we've made it open source, and we are the only fund making all our investments through iSafe, because that's what a seed fund needs to do at our stage, not typically a larger VC, because there it makes sense to have a shareholders down agreement.
Okay, just to ask Shashank, did it start like a family office fund, and then it's getting larger and larger now?
So we were very clear from day one that we wanted to have a SEBI registered fund. And follow that process. That being said, it is Sanjay's idea, and Sanjay's family office was and continues to be the largest LP in the fund. And yes, it is growing now. We are growing in size. We are growing in number of companies we want to invest. You started the conversation by saying 100 companies a year. That is and continues to be the vision, but we've not done 100 till now. We've only done 70, and I'm announcing the new set of investments on April 8th. That should put us at a cumulative portfolio size of 80. But the intent and ambition is to invest in 100 companies a year in 2022 for sure. That's the objective, but we haven't done that so far.
Okay, Shefali, you had a question.
Yes, I just wanted to add to that. So Shashank, you've done so well so far, and the combined valuation of all 60 portfolio companies from the first 5 cohorts was 211 million. And that's awesome. So how did you do that?
How did you manage that? Yeah, I've been reading about that. I've read that in a couple of newspapers. Is that true, or do you think media people are taking a dig at you and saying, yeah, it's doing well? But it's a lot of good blessings.
Sure. No, so I think if you look at the simple process, we come in as the first seed investor, all right, and without a valuation, right? We give them the capital, we start working with them, and these are companies either, let's say it's a deep tech company, they're building their product, there's still product validation which needs to be established, right? And then there are companies which are doing some level of revenue, right? But either way, it all leads up post our investment in terms of business network, in terms of getting them financially disciplined, all the way up to a VC pitch day. Now, VC pitch day is a discovery mechanism, because we are a discovery fund at the end of the day, for pre-series A investors to come in and look at that. Now, very much like the YC, we wanted to get this established. And what is happening is, on an average, our portfolio companies are raising 400K to 600K at the VC pitch day within the first 10 days. Now, that is a huge achievement and huge milestone for the Indian ecosystem, because on one side, you have the investors coming in and committing seriously, and the companies which are rising from a MVP stage going all the way up to price discovery for a pre-series A. Cumulatively, we've raised 55 million USD for our portfolio companies, 70 of them. Now, out of which 8 have now gone for a Series A. One being Smiles.ai, which just raised 23 million USD, balance 7 to be announced. Now, the valuation which you're quoting is the level of money which they've raised from follow-on investors. So we have had 76% of our follow-on investments after our round come in by growth stage VCs like Lightspeed, Chirate, Startup Exceed, multiple of those, and 24% has come through SQL Safe Notes. So to answer your question, the valuation is a function of how much they have achieved since our investment in terms of getting more market ready and their product finding a more a product market fit, so to speak. And second is their ability to have a valuation which is agreed upon by the incoming investors, like many VCs. And then that cumulative number for those companies who've raised that is the figure which you've quoted, Shafali. And that's the process. That's the objective. Bottom of the pyramid, taking the companies all the way up and helping them reach a pre-series A to Series A.
Yeah. So, okay, go on, Shafali. Go on. You had a question. Go.
I'm sorry. Yeah, I just had one question. So basically, how risky is it, investing in the MVP stage?
Very risky, but okay. The upside is also equally high, right? As I said, it's just a function of where the ecosystem is. There are many Series A funds, there are many Series B funds, but also on one side, there are many incubation centers and accelerators. But we saw this opportunity. Nobody's taking this risk of giving money and then ensuring that the MVPs reach a product market fit. It is risky, but if it succeeds, then the amplification of growth is very, very high, both for investors as well as founders. Also, what's important over here is that it gives, it kind of alleviates, it brings up good ideas which just needed some capital, and their probability of succeeding in achieving a Series A round, it increases that. And that's the space we wanted to address. So risk is extremely high. A lot of companies will fail, but at least in this positioning, they are able to experiment. They're able to access network like 100x, CIO network or market network, and at least experiment. And worst case scenario, we lose the money, which is a write-off. They haven't built a product which is required by the market. There's learning. But if you do that for 100 companies, we're hoping that at least 90 of them are successful. Some will not succeed, but that's the function of the fund. So it is risky, no doubt.
Okay. You guys have been building a community for a while now. You have the podcast running. When you started off, right, what is the reception like? The reason I asked this, you need to have a robust follow-up system or tracking system to track these ideas coming in, right? Shashank, every year, I think you get thousands of ideas. Is there a machine learning algorithm that looks at your investment thesis, which means you have to tell me your investment thesis? I know you're agnostic, but for the others, You can tell them what is your thesis and themes maybe. And then how do you pick ideas that work, to follow up to Shafali, right? MVP stage is risky. And then how do you ensure that that cohort is the best cohort that you picked out of the 1,000 odd applications that you may be receiving?
Sure.
How do you do that at scale? I'm just wondering, is there a team of analysts sitting, tracking market research, people looking at the numbers, IRRs, or is it just gut feeling that you invest in? I'm curious to know this.
Sure. So to be very honest, it's a mix of both. And I think I'll give a higher percentage to gut to begin with. Now, let me help break it down. It's largely a manual driven process. When we started out in July of 2019, and our objective was, can we get more applications coming in to us so that we can then systematically start evaluating. And because Sanjay has done 150 plus investments, he had his own personal network, plus his portfolio companies were recommending companies. We had the first set of references coming from Sanjay, and then obviously Ninad, Yagnesh, myself, and Vatsal, we had been in the ecosystem, so we got a bunch of references. Eventually, organically, we had a community where people started associating with 100x. We started doing interactions with a lot of incubation centers, accelerators. So we started getting a lot of applications. Now, to be very honest, it just was a process of opening your inbox every day in the morning. You got 50 pitch decks, going through them, and just taking a call. Okay, this might be interesting. Scheduling a call through Calendly, or just picking up the call. Boss, I need to speak with you. I'm calling from 100x. Let's get on a call. I want to understand. Do that in 30 minutes. Try and understand whatever you can. If it's an idea, and visualize that, does it make sense, and see whether it is something the IC would be interested in, and do all of this in the shortest time. So our turnaround had to be less than 24 hours of pitch decks coming onto the email ID for us to speak with them, then send out a form, and then evaluate them, and then get them to an IC call. And if the IC decides to invest in them, do the technical due diligence, financial due diligence, and wire transfer the money. All of this in 15 days. That was the motto. And it has been a very manual driven process up till now. We've evaluated 20K startups over the last 70 investments we've done. And it has been a function of outreach mechanism. It has been a function of references from current portfolio companies, Sanjay's portfolio companies, and a lot of hard work. It's not a very glorified growth stage VC kind of a profile. It requires you to put in the hours just to review decks. Some of them are very bad, but it needs to be done, and then share feedback with them. And the ones which you feel are good, you kind of go ahead. Now, in terms of the evaluation, these are very early stage companies, MVP, in early traction. We are very sector agnostic. Largely, we are looking at the founding team. If they have a pedigree, now by pedigree I mean work experience of having built something good. But in many cases, in 100x portfolio company, we've invested at least 30% of our portfolio companies have come out of college students, fourth year students, fresh pass out college students, right? And there you're trying to understand what are they building, right? What's the next big thing? Do they have the passion? Have they stumbled upon something which they think they can scale, and they can help us understand the tech trend, right? So founding team plays a major role, which is largely a human or a gut thing. Ye banda chalega, nahi chalega, that kind of a thing, right? There's no data here, literally no data. And that's where I feel for all of us, and me personally, Sanjay's ability of having built out 150 portfolio companies helped us kind of get us kick-started with the whole 100x vision, right? Because he dealt with so many founders. A lot of insights came from him. That's how we kick-started. I think second, obviously, is market opportunity. While that can be a cliched statement to make, but the markets are evolving rapidly. Domestic consumption markets are increasing rapidly. Tier 2, tier 3, reverse migration, whatnot, has just amplified the consumption of products and services. So if you look at it, it's a flattened play field for the Indian economy, and therefore we are very sector agnostic. So market opportunity is something which we look at, but it's not very easily defined. And lastly, I think we try and look at moat. So I mean, founders, pedigree, business model, market size, moat unfair advantage, which is again not easy to define at this stage, but it's a combination of all these things. Hence, I said larger percentage to gut, and there's only few data sets which you can go after, right? So a lot of personal interaction. Do you think this guy will survive if the, for a lack of better word, if the shit hits the roof? Will these guys be able to pull their sleeves up and do those kind of analysis? Is largely what happens at this level. It's just that it needs to be done regularly and needs to be executed really fast.
For you, it's not the vertical more than the horizontal, right? Or is it a combination of both vertical and horizontal? You're agnostic, and I think you should invest in tech, right? About time, right? I think you have done enough branding and you're known well enough now to handle that at scale. Is the tech coming through for you guys, or is it still going to be manual?
So one is we are sector agnostic, right? So it's horizontal for us in terms of the sectors we pick up. Our preferences tend to be, when we started out, we naturally understood B2B. We didn't have a deeper understanding into, let's say, D2C kind of a brand, but we slowly realized, when we invested in Kerala Banana Chips, the association was because we felt that we could add more distributors through our network to kind of expand his presence in Bombay, right? And that's how we kind of built out. Today, we are standing on a large, B2B, B2C, and D2C kind of brand portfolio. Second is so Vatsal, our CTO, who you've interacted with multiple times, has already automated a lot of stuff during COVID for us. One is our VC pitch days have become completely virtual, standardized for investors to come in, view, and look at information, book meetings with the startups, and everything to the point of wiring the money, right? That's an automated process. Even on the deal sourcing part, whoever's reaching out to us, there are multiple filters which are being captured, and there is now a process of which companies actually reach the first level of evaluation and then eventually make it to the IC. Because at the end of the day, it is a volume game also. Unlike many VCs, which do less number of deals, this will be a function of large volumes and the ability to manage that volume.
Shafal, you want to ask a couple of questions? No, why don't you go ahead? Because meanwhile, I'll curate the audience questions as well. There's so many of them there, 8 or 9 of them. So let's go for it. So Shafali, go over to you.
Sure. So my question was, so a lot of entrepreneurs come to you, right? And what is the pitch that you expect from them? And what are some of the kind of pitches that you get from them?
Especially with a 13-minute phone call, you just said, how do you know in 13 to 15 minutes, how do you know that this person...
30
minutes. Okay, 30 minutes. How do you know? 30 minutes on a phone call.
So I think what we are typically doing, for a large VC, the kind of companies we'll invest in may be clubbed as idea. But for us, idea, MVP, and early traction is very different, right? So we don't invest in idea companies, right? So if somebody comes up to us, say, hi, 100x team, we love you guys, and I have an idea to build a deep technology companies, and here's my plan. We wouldn't invest in them because we need something tangible. We need something representative of what they intend to do. They might not be selling in the market, right? So it cannot be an idea. It needs to be something tangible, even if it's a beta version product, right? Now, when we look at these companies, when we receive these decks, we are trying to establish which stage are they at in our mind. By early traction, we mean, okay, they've maybe sold to 4 customers. That is early traction for us, not a recurring business, right? Which many high growth rate VCs want. That's not the definition for us. For us, it's different. So we'll always try and identify, is this an MVP, product ready or launching, beta version, alpha going, some traction, 5 customers, 4 customers, is the level we are trying to establish. Once we establish that, then the 30-minute conversation, which is with one of the 100x partners, is to get to know the founders, their background, why they started this, why is this market important to them, is this a painkiller for them, or is this something which they read in a movie or a newspaper and think, acha, hum bhi karte hain, or if they really thought through, this is a problem, boss, and we want to solve this. I'll give you an example of Blue Learn, which got funded by 100x and then Lightspeed. Vatsal in fact interacted with them and had been chasing the company for at least a year and a half. They were in 3rd year and they were trying to build this community. And when we funded them, they were in 4th year and they had built out a 30,000 sticky community, right? and we were fascinated with this zeal. We thought this is possibly a side project to impress a girlfriend or a bunch of family friends or whatever, right? I don't know, we don't know, right? But they were so clear that I felt useless about my engineering days. That what did I achieve? The clarity some of the founders have is amazing. So I think that is one thing which we try and understand the intent. Are they serious, or is this something which they've read a lot in news ki maybe funding milega to start karte? These are very important things to look at our stage, and that's what we try and establish. And obviously our understanding of the space, do we think we can add value? Do we think after we've, let's say, funded this company, can we ensure that we can add value enough to get it more metric driven for them to raise the next round, which is important, as I've said earlier, their ability to close the round within 10 days of the announcement, right? So that's how we kind of build out the entire process, and these are the things which we look at while we are evaluating companies.
Yeah, shall we move on to audience questions? Would you want to take them, Shashank? There are several. There are about 14 or 15. Let's start off. This is from Abhilash and Vanya, who are the founders of Frizzle. Okay, they say their website is frizzleweather.com. They're interested in one thing, that they're building a product that can help logistics companies and several other manufacturing units understand weather as a critical measure to safeguard their mission critical applications. Okay, how do people understand deep tech in India is a question from Abhilash and Vanya. How I mean, if they have to pitch to you or if they have to come to you, would you give them time? Because several times they say that a lot of people think weather is like Google. I have Google weather, that's enough. But they say it's not enough. It can help people driving. You need to have precise weather condition data. You need to be able to use weather to understand whether a machine fails or not. At what stage does the company intervene? They say it's a strategic thing. But when they pitch to a VC, and as young as they are, they're from university, how do you get a VC's attention for that one thing in 30 minutes and make sure that they seal the deal? I think a lot of the VCs that I could go to, the larger ones that I go to, lose interest in 4 or 5 minutes, right? Generally speaking.
Yes.
So how do you manage this?
So I think there are 2-3 things, and this is what we try and tell many of the founders. So you need to understand what stage you are at. If you're at an ideation to an MVP stage, you should not be reaching out to a growth stage VC fund, right? Because they won't resonate with it. They haven't seen anything. For them, as I said, it will be an idea. You need to build that conviction. Now, today, Vishal and Shefali, all of us are at a great point in 2022 in India, because deep tech has support by the incubation fraternity, right? Department of Science and Technology, Atal Incubation Centers, to kind of move to that level, right? BIRAC has grants being deployed for developing various kind of technologies. So those avenues are there if the founders are determined and they can find those channels to kickstart. Second point is that once they've done that and they've reached that some at particular stage, there are multiple deep focused funds, deep tech focused funds. For instance, Inflexer, who works very closely with 100x, they've invested in one of our deep tech portfolio companies called Victor.ai. We run a fellowship program for deep tech companies, 100x portfolio deep tech companies with Inflexer. Whichever makes the cut is then funded by Inflexer VC, because they are deep tech focused, right? That is very, very important. But all these VCs will need a certain metric or a traction. At 100x, Vatsal is a go-to guy for understanding everything tech, and he spends, once we've understand the 30-minute conversation, we then schedule another 45-minute conversation just to understand technology. Is it open source? How unique is the deep tech? Is there an IP to it? So when you are approaching an investor for a deep technology product as a founder, you need to be cognizant about the stage you are at. At 100x, as I said, we've invested in, I think, now 12 deep tech companies, and we will continue to deploy capital. But we don't invest in deep tech companies who are growing, who are already raised some level of capital and are going for a series A. That's not the kind of fund we are. But if you are an early stage deep tech company, then what we do is we look at establishing your backend. You're doing a technical due diligence. So you need to understand which type of investor you're going after, and therefore will you get the attention span. If that's my response to that.
Very well said, Shashank. And also they follow on, one year follows up saying if they've already raised some seed money from in private investors, can they apply for 100x.VC?
So largely no, because we are typically investing in bootstrap businesses or companies which are, at least 96 to 97% equity is held by the founders, right? If they've already raised some capital and deployed, diluted some equity, this means that they are possibly now getting ready for a pre-series A, right? Then we are possibly not the right set of investors. That being said, we have invested in companies where some level of dilution had happened, or some investors had come in where they had used a convertible instrument, right? Even in some cases, they had diluted some amount of equity, either through incubation centers also. But largely, we look at bootstrap. Those businesses get us excited. Adding to Shefali's point, those are more riskier, and we like more risk associated. But that's the way the fund is structured. But that being said, at least 10% of our portfolio companies have been funded by 100x, where earlier investors were present.
Brilliant. Shefali, you were asking, go on.
Yes, that's great to know, Shashank. So does 100x.VC play the role of a coaching strategy consultant, and what exactly does this mean?
Sure. So, once we've invested, then our objective is to get them to the next level of funding, right? And that's a function of multiple steps. So the first step is I'll give you an example of SaaS, and this is not particularly to SaaS, but any company. But let's say if it's a SaaS company and they've just rolled out their product, right? And they are in conversation with one or two customers. Our first objective is to establish the utility of that product. We believed in it, hence we invested. But now, can we help them grow over the next 60, 90 days and get them a set of certain customers, maybe a top-down approach through our CIO network, right? Get them more validation and increase their pipeline, so to speak, right? And drive that. While that is happening on the parallel side, is the product scaling properly? Are they doing enough bug testing? Does the product have enough bandwidth? Suddenly, if they get 10 customers, do they have the bandwidth to sustain that, right? Check for those things. Third, how are they managing their balance sheet? They've received our funding and they're working towards getting a bigger check. Do they have the bandwidth? Do they have the mindset to conserve capital, to apply? Where do they want to apply? How much percentage of capital is required for product building, for hiring? Guide them towards that. There's a lot of people think, okay, now that I've been funded, I'm going to use 50 lakhs for marketing. You don't need that. There are multiple growth hacks you can do. Why don't you use that money? So check for those things, keep those checks and balances in place. And lastly, based on all these things, get them metric driven to a certain point where they are becoming relevant to the Lightspeeds, to the Chirates, to the Axels, right? Because the objective is get them to a pre-series A and series A. And that's what we've been working towards. A lot of VCs have been investing in 100x portfolio companies at the VC pitch day. And the objective is that. So consultant strategy, GTM, go-to-market strategy, product launch, even marketing hacks, right? Or even to the extent, and which actually is not spoken about enough, but plays a very important role, is PR. Through 100x channels, can we get them more eyeballs? Can we get them more visibility? More so in D2C brands. These are the things which we have to work with them, because these are very early stage companies. And
you don't charge them for all this, right? Shefali, go on. Yeah.
No. So our model is very simple. We are a single focused fund. Our revenue model is only at the time of exit. There is no fees to any of this. We are an investor. We invest first. We start working with them, and we take them to the VC pitch day. And if they get funded, that's a success, because we get converted to equity, and our exit is at a series A or a series B. We are yet to take our first exit. So we've just been investing, and our only model will be an exit at the time of series B.
Okay, this is brilliant. This is Shefali, you again wanted to ask him something. I'm sorry, I interrupted.
It's okay. That's really okay. So I just had a follow-up question. Could you tell us some, about some of the companies that went from seed stage to Series A?
So we have 8 of these right now, and I can talk about one. 7 are yet to be announced. So the PR will release. But all right. So one is Smiles.ai, erstwhile Doc32. We invested in them in class 01. They are building a brand for dental clinics, and we funded them in 2019 September. They ended up raising from Sequoia at the VC pitch day, our very first VC pitch day. In December, we announced the VC pitch day, and January they closed the round with Sequoia. And now they've raised a follow-on funding round of 23 million from Sequoia, Chirate, AlphaWave, which is a Falcon Edge seed fund, so to speak, but they're making significant check sizes compared to India seeds. And so that's the first Series A, which got announced. We've had significant check sizes. I wouldn't say Series A, but pre-Series A. So Pocketly, again, a class 01 portfolio company, raised a 3 million right now. Data Sutram recently closed another round. And as I said, all the other companies have been continuously raising money up to 500K to 600K right after the VC pitch day. And many more companies will be announced. So I shall keep you posted, Shefali. We have at least 7-8 announcements coming in, but it's all shaping up. So see, that's the objective, right? That if you're able to, build out companies which are going to a Series A, this means there's adoption. There's adoption to that product, and there's a requirement for that, right? And many of these companies are serving India. That's the brilliant, right? That's the brilliant part. India in itself is such a huge story. We have SaaS businesses being built out of India for the first time, not for US market. Building out of India for US is there. Many companies use that, but building out of India for India, because we've got a second generation companies coming in like Flipkarts and other
all the unicorns, all the bigger companies. Yeah.
Those companies. So it's a great environment, and I'm very happy to say that we are able to succeed because of the growth stage VCs, because they also believe that these models are emerging and they're backing it. They're seeing belief in these founders, and they're seeing a validation of the product. So these are some of the examples for Series A, but I have more coming in your way very
okay
soon.
Okay, great. There's a question here which says, how much time does it take before the round pre-Series A and Series A happens? And again, the different stages, right? Are there smaller rounds than pre-Series A? Because you're at the seed stage. Does a pre or a post-seed investment, maybe a higher angel round, does that happen? And at what stage, and what are the metrics? If you can define that, are there defined metrics for you guys to achieve with the startup?
So metrics depend on company to company and sector to sector. Like a SaaS metric would be different, and a community-based platform would be different, right? Beyond that, also pre-Series A, Series A, pre-seed are all nomenclature. So let's break it down in simple. Your first check is where 100x wants to be, is a seed or a pre-seed, whatever you want to call it, right? Now at 100x, when we invest, we are looking at the next level, whether it's seed or pre-Series A, to happen within 90 to 120 days, because that's when we announce the VC pitch day, right? And that round should get closed within a span of 10-15 days after the announcement, and that's what's been happening at 100x. From there on, really depending on the sector and the ability of the business and product to capture growth, I think we've seen that typically it can go for 100x portfolio company. It's been within as low as 6 to 8 months, all the way up to 18 months to their Series A. For instance, Smiles.ai, we invested in September, January 2020, they raised the next round, and then obviously now they've just announced that, which actually was a round early in 2022, right? So 18 months roughly, and that's the timeline. Now, Shivali, back in Vishal and my generation is quite different. So 10 years ago, it was a very different ecosystem, right? Raising a Series A could have taken you easily 4 years, 5 years, right? Today, the dynamics are very different. You have unicorns being built out of in 6 months. It's an extreme case, but a unicorn is being built out within 2-3 years, right? So to answer the person's question, there is no fixed timeline. There are multiple variables. If you're a SaaS business, you're growing incrementally and exponentially, you have recurring clients and the margins are increasing, or your recurring business is increasing. And a fund comes in and they are able to expand your geography to another country. That amplifies. A lot of factors come in, right? So we are seeing that on an average, after a seed funding, if it's a great product, great team, you can easily raise after a pre-series A. Your series A can easily come in within 12 months to 18 months. That's how aggressive, that's how amazing the Indian market is. All you guys need to do is pull up your sleeves and work, right? You have enough capital.
Okay. Shashank, I know while most of us talk about the nice things also want to ask you, did founders give you a hard time? Somebody you thought, not just, let's not name anybody or diss anybody, but I want to know the general experience of this madness, right? Sometimes you're convinced that the entrepreneur is great, convinced that he or she will do this. And I know you don't interfere much into the operations of the business. The founders have to figure it out in the end of the day. But have there been disappointments, and how do you handle those disappointments? Do you say, okay, we'll part ways with a shake of hand, or how does this happen? Have you had bad moments also?
No, so I think when we started investing, Vishal, I think as a young fund, we also encountered COVID, right? So we ourselves were going through a new spot, and I think every company was going through their own set of challenges which needed to be addressed first, right? So that was also the time we realized who's willing to pull up their sleeves and actually double down in a case of ambiguity, right? And we saw many of our portfolio companies survive that through persistence. It's as Sanjay likes to say, like, you feed the winners, you starve the losers, right? And there's only so much you can do. So if somebody is not able to take feedback beyond the point, from 100x perspective, eventually it will be a write-off. We don't part ways. We've invested, we've given them a direction, they need to execute, and we have monthly updates, right? But if it's not happening, then there's only so much time they'll get from us beyond a point of time, because you're not going to take back the money. It's eventually if it fails, it's a write-off from our side. We'll start deploying heavy energy and time into those guys who are making those changes, who are succeeding. And if they need more help, we can put our shoulders and take them to the next. So that's where the effort needs to be put in, right? So, but again, I'm not blaming the founders who are not able to do it, because there are multiple. Some of them are first-time founders. Some of them don't have the discipline. Some of them actually realize that they are not cut out for entrepreneurship, right? After they've gone through the first, there are multiple things which happen, and some of them end up only building lifestyle businesses. So
you're saying it's okay. So you're saying it's okay to go through these challenges. It's normal, and you shouldn't take it personally.
No, it's okay. It's okay. We certainly push founders that when they're entering entrepreneurship and they're raising VC money, they need to have the mind of scaling up. But that sometimes many founders realize after raising a seed fund, right? And many of them then start thinking that, is this the right path, or maybe I should stick to a 9-to-5 job. But besides that, as I said, to Vishal, you and I come from a time where the whole ecosystem was on the reverse side, top of the pyramid, private equity and venture capital. Now the second-time founders coming in, first-time founders from tier 2 city in coming in for the first time and starting. There's a different ecosystem altogether, right? So mistakes will be made. Founders will they'll experiment, they will fail, and they will make mistakes at somebody else's money expense, right? But that's okay to do in our model, right? Because we're doing 100 investments. We still are trying to identify winners, right? Some of them would be misses, but our objective still remains, have we identified the next big opportunity? So hence, possibly it's a mistake at our end. We didn't identify the right founder, right? But it's all part and parcel. I think the objective is it will continue to grow and continue to be there.
There's so many more questions, guys. I'm going to try to get everything in. Suresh obviously asked, he's from CoCreate, obviously the founder. He asked, at the product stage, do you invest at the product stage, which is the MVP, right? Or what stage do you get in?
As I said, anything which is not an idea, anything above that is an investable opportunity for 100x.
Okay, great. This is Gaurav, who's a student who asked us. He's saying there's a lot of news about certain sectors being unicorns, especially on the edtech side. You also, on the other side, you have unicorns, and then you have frauds being committed. It's all over the news. Sometimes it's disheartening on what to believe, right? Do they build to be a unicorn, or what should young kids get inspired by today when they see all this news happening? Basically, Gaurav wants to know, what is the VC ecosystem in India turning out to become?
My advice to Gaurav is stop watching the news, right? Stop watching it.
Build the product.
Build the product, right? Right. I mean, stop watching them, because these are founders. Some of them just gone through bad cycles. There's a mature cycle. I don't think so. That should be a indicator. I think what you should be focused on, if you stumble upon certain problem, right? Like for instance, we are trying to understand how Gen Z is operating. All right, what kind of products makes sense to them. You guys are not the ones who are going to go to a bank and stand in the line, right? We come from that generation when my dad used to send me to deposit a check, right? And we even then used to crib. I don't want to go.
I remember I hated I hated those lines, right? So we all did.
Right. So times are evolving. Generations' ability to adopt certain mechanism, processes, products is evolving. And if you think that in the current environment, if there are challenges, and if you feel you can address that, then your primary focus should be that. Because if you're able to build a channel and there's enough market, a VC will come in. To answer your question, how the VC ecosystem is evolving, VC ecosystem is here to stay. India has never had so much capital to be deployed at multiple stages. Multiple. I kid you not, this whole bottom of the pyramid and growth stage, VC, pre-seed, never used to exist in 2009. So you guys are sitting on a golden opportunity. And if your focus should be only building a product. Once you start growing and you have the right partner, right? And by partner, you mean investment partner who guides you, right? Even in Series A, right? These are not only providing you capital, they're providing you because they built out billions. They built out companies which have made billions, right? And they have built out more than profitable businesses. They've built out a culture, ethical practices. And those are the insights you'll learn. So you won't get that from news, right? Some of them fail sometimes for multiple reasons, but don't look upon those negatives. I think your job should be, if you truly believe there's a problem to be solved in India, go ahead and build a product, because there's experimental capital, there's legacy capital, enough capital to back you.
Okay, Shefali, you had a question.
Yes, I had a question. So usually at what age do your entrepreneurs come to you, and do they come when they're building their product, or do they come when the product is already in the market, or is it still in the ideation stage? Do they come during that time?
What's the average age also? It's a good question, because I wanted to add to that, right? Is age really a number now, or can people who are 42, 45 or 50 plus can come to you too?
Sure. No, it's a great question, and two parts to the question. One is the age and the other is the stage, right? So and the ones which we fund. So I'll begin with the stage of the company. We get a lot of companies applying to us: idea, product built, not launched, product launched, no revenue, product launched and generating recurring revenue. And we get all of these. We invest in all of them minus the idea stage. The age group, we have invested in 70 companies now, and 25 to 27%, to be more precise, portfolio companies are women co-founders. And I would say at least 45 to 50%, or maybe 50-50 split, is of founders, or 60%, I think, would be founders in their age group of 20 to 30. And the balance would be 30 to 40, 42. I think the oldest founder we have is possibly 45 or 48, but I'm not sure on that. That needs to be confirmed. But it's not, the age is not a barrier. As I said, we want to identify businesses which are going to be servicing, catering to the next generation for the next 30 years, right? So it's very futuristic. We don't have the answers, so you guys have the answers as founders. So we're trying to kind of just bite into that pie.
Okay, great question, Shefali. You have another one, Shefali, you want to ask? Go for it.
Yeah, just one follow-up question. So
go ask as many. The show's about students, so go for it. Go on.
Yeah. So one follow-up question is that after, like, post-pandemic, what are the different kind of pitches that you got, like different from like what you just used to get before? Sure.
So a lot of pitches around students really started ideating, and a lot of founders who were a lot of employees who were working in large organizations left, and they went down to their hometowns and decided to start something else. So we heard a lot of new businesses coming out. And that's when I said, the bulk of our experiments came from investments came from funding final year students to fresh out of college students. We were looking at investments from all sectors, ideas from all sectors, and some of the ideas which stood out many a times was that we are building something related to COVID, and which was myopic, good intented, but myopic. And then we saw businesses around, how can I address this problem by building a solution which is makeshift, right? So whether it's hand sanitizers, or building robotic arms which can hold things, which is good thoughts but not scalable, right? But then on the other side, we started seeing good set of scalable businesses. Like SaaS really accelerated during COVID. It had been in the ecosystem for 10 years. And they founders started building out businesses which started having a lot of utility all of a sudden, right? So we started seeing multiple set of companies. We also started seeing a lot of company in gaming and media tech, right? And that led us to kind of work. So there's a lot of sectors which came up, which we had to study. We had to understand where are the models emerging. What was fascinating about COVID as a for a lack of better word, unifier of global practices, because everybody was going through the same thing, right? Everybody had the same challenges, and therein Indian entrepreneurs started building out solutions which were also relevant to India as well as anybody in the world, right? And we started seeing those kind of examples also. So there's a company called Sales Assist which built out virtual customer care video services for e-commerce portal, right? And a lot of these interesting deep fake companies started coming up, right? So we invested in Group.ai, where they were building deep fakes to kind of keep the marketing engines on. We had Victor.ai, which was converting any text. So a lot of dubbing studios went under the underground because of COVID, right? But so there was a lot of content which was already generated. So Vitra here said, I will convert any content into 52 languages without sounding robotic, right? So now suddenly all training organizations, all entertainment studios had access to this software, right? And so some brilliant ideas came through, and I think we were just lucky to be at that point witnessing those changes. So multiple types of decks, some long-term, some myopic, well-intentioned around COVID, weren't scalable, but we just saw many ideas coming in.
Interesting, Shashank. I mean, there's so much knowledge and so many questions to take on. We'll take a few. We have 7 more minutes, ladies and gentlemen, and we'll take as many questions. This is Arjun. He asked a 2-part question. He says, what drove you to become a venture capitalist? Because you'd said that major portion of your life, there was no plan. But what drove you to become a VC? Okay. And perhaps his experience in VC circle would have changed that, I'm sure. You can say Absolutely. That. Because we also briefly crossed paths there. Yeah. And he asked, can you share a moment in your life that made a huge change in you for the better and positive? Because there's because of COVID, there's so much mental illness going on. And what does positivity mean to you? It's a great question, Arjun.
Sure. I think the reason why I ended up in this is, to be very honest, as I said, right after MBA, I joined VC Circle, and VC Circle really gave me insight into this industry. So when we were fortunate enough to see the company get acquired, and the entire founding team moved out, I decided I'm not going to go back to a large company like a Bloomberg to sell databases. I was very clear on that, right? And I thought, I know so many people in the industry, let me just try my hand. And I was rejected by so many VC firms because, I came from a secondary research background, but the motivation came from because I'd prepared a secondary research database and we built out a SaaS product. I'd seen so many companies that I wanted to experiment with that. And I was looking for any small window, and that came through the next journey I took. And then I decided to do angel investments. So I started experimenting, and that's how it all started, right? I really started enjoying this asset class. And when I say asset class, if you treat gold, real estate, this is an asset class, right? So it started making a lot of sense when I'm coming from a background of research and then moving in the front seat. There are a lot of correlations you can do, right? And it started to make sense to me. So that was the motivation behind investing first in this asset class, and then VC, I think, was a tag associated with it.
Okay. Shefali, do you have any questions at this point of time? Otherwise, I'm going to go on to the audience questions. Go on. Do you have anything to ask?
Yeah. So I had one question. So what's the average age in your company?
That you didn't
I'm
answer.
very curious, sir. Yeah.
So
very
average,
curious.
as I said, 20 to 42 is the range. So I think average, I haven't calculated it, but I think it would be on an average 25, 24, 26.
It's getting younger, Shefali, if that is the question. It's not.
That's interesting.
It is. No, so that's an indicator because, Startup India, DIPT, registered companies, the multiple registered company coming in. And it's so good to see that, the younger generation between the age group of 19 to 25 are contributing significantly to that registration process, right? So they're forming companies, they're going out, and I'm positive that the number is likely to increase, and hence, as a function of that, we are likely to increase in that set of folks even more. And
Okay.
more.
Okay. Here's a question from Harish. He says, at the founding stage, most of the engineers of the company or the founders are focused on product, and they may be very good at it. Where do they fail? Sometimes is it because of bad marketing? Is it because the customers don't see value in the product, or is it too early in the game? How do you find that right balance if you're a B2B company? Is it the marketing that goes wrong, or is it just basically founders don't have the will to sell and they have to employ a salesperson?
I think you touched upon it. I think selling plays a major role because B2B products have a longer gestation cycle. The turnaround onboarding of a client is slightly longer, right? And some of the folks don't understand and appreciate the process behind that. That kind of erodes the initial enthusiasm and then kind of, takes away the enthusiasm and affects the company and growth. The second is, even if they crack, and that's why, your investment partners, advisors kind of help you kind of channelize that energy. The second is the ability to build the right product also, right? Is it actually solving a utility for an end user, an analyst, or a procurement manager, or an HR manager at that B2B enterprise, right? Getting into that person's mindset and their motivations to use a tool, right? I mean, like, for instance, everybody has heard of Salesforce, right? Vishal, right? And getting Salesforce filled is a challenge, right? So, and while sales people are the ones which lack discipline, right? But others are slightly more disciplined, but their motivations are different, right? So who's the user, and is the product going to be utilized, is the second reason, right? So founders, we feel, sometimes have not done enough research on building out the product, right? On anecdotal references, talking to some friends, oh, this is cool, let's build this, but without getting into the granularity of the utility of the product is where founders fail. That's the second point. But I think first is also, a lot of founders think that I've started a company, I'm the founder, I need a SECI and I need a sales team to sell the product. Boss, you're the CEO, you're the seller, you're the marketer, you're everything, and you're also the office cleaner when your maid doesn't come, and the utensil. So that mindset is very important, which we feel sometimes is a huge miss, where people think I can't sell because I'm the founder, but that's a wrong mindset. And surprisingly, that has affected a lot of companies. That's a mindset. You might be a product person, you reach a certain scale and you can get a salesperson, but till then you're the founder, you have to sell. So selling and the product utility, I feel, in my mind, are two biggest failures which happen, which kind of stunts the growth and you're not able to go to the next level.
Shefali, you unmuted, so I thought you had a question. Go for it.
Yes, I had a question. So how did 100x.VC build its community, and how much does it mean to you, Shashank?
So community for us.
Shashank, just to interject, sorry, Shefali, I'm following up on a question because we're running short of time also. You had 200 VCs attend your pitch sessions, right? I mean, globally, how do you manage that? And therefore, the community is important. How did you do it?
So I think our first objective of community for us means founders community, more importantly than the investor community. Founders are the most important. We need to be connected with the incubation centers, accelerators, the state government organizations which are in nurturing startups, and that's where our maximum effort goes out in terms of building a community. The second, in terms of investor community, is something which we've slowly built because of the success of the companies we funded, right? Or they being able to resonate with these investors. So let's say if we had 100 investors come in at the first VC pitch day, today we have 500 VC pitch investors come in at class 06 VC pitch day, right? Because they've understood the kind of companies coming out. So that's a function of the community which we built out with the founders, and hence at 100x, founders remain the primary focus. Because if you're not able to identify the right set, build a community around that, we won't have the investors coming in after 100x invest in them. But in terms of community effort, I think I missed this question earlier. Somebody, I think Vishal, you'd asked me. We've done a lot of video podcasts. And that was primarily because during COVID, we were not investing. We didn't know what was happening. And we decided that, a lot of portfolio companies, a lot of other community people in the ecosystem need to be given content. And hence I did a bunch of sessions with incubation centers. Sanjay did a lot of sessions in terms of what to do in this pandemic, because the objective was, can you give out more content? The other final point on community development, which we're doing for founders, is our Gurukul initiative, which is non-for-profit, non-equity, non-fee based program, where we run a free 12-week program with recorded and live sessions of each cohort having 200 to 300 applicants, right? And these are not companies which are funded by 100x. This is just a non-for-profit initiative which we do. And so all these things lead to a heavy focus on founder-driven community. And as a function of that, identifying good opportunities, investing, and then the investor community. That's always going to be the focus for 100x.
Lovely, guys. It's already 6 o'clock. Thank you for being on Pebble by CoCreate. Pardon me. There's so much public questions happening. I'm losing my mind. There are about 15 or 20 of them left. But guys, we'll get Shashank to answer all of them for you. We're going to put it in the description on YouTube. You can answer it. Thank you for being on Pebble by CoCreate. Shashank, I wish you all the best, and hopefully, many more startups come to you, and hopefully when you're in Bangalore, you come and check out what CoCreate is doing with universities and work together. I look forward to that. Also come and inspire our students. For those of you who want to write to Vishal at CoCreate.Ventures. If you're an idea stage company, if you want to connect with Shashank, send it to me. I will connect him personally to you. Shashank, you're wonderful. 100x.VC is doing a wonderful job. Shefali, thank you so much for being a community leader and coming on the show. We'll catch up with you soon on Thursday. There's another live coming up with another VC. Shashank, see you soon.
Thank you, Vishal. Thank you, Shefali. Thank you so much. Absolute pleasure.
Thank you so much.
Take care, Shashank, and I'll see you in a bit. Bye-bye, and that's a take. Lovely. Shashank, thank you so much. I will get you. I'll tell you what, I'll connect with you separately. And there's so much to do together. Thank you so much for your time.
Thank you, sir. Thank you so much. Thank you, Shefali. Take care.
It was great interacting with Shashank. Thank you so much.
Take care. Thank you for your question.
Bye, Shashank.
Bye.
Bye. Bye. Right. Thank you very much. We'll all see you in a bit. Bye. Bye-bye.